Hi, this is Brian Vendig, President and Chief Investment Officer here at MJP Wealth Advisors. We have a chock-full week ahead of us of some economic news coming out from the Federal Reserve, and I thought it'd be a great opportunity to check in with all of you and give you a little bit of a market update for the balance of 2025. First, let's start with the Federal Reserve. There has only been 3 times prior to this week that the Federal Reserve cut interest rates while bank stocks were at all-time highs. And we believe this is going to be the 4th. So there's pretty much 100% probability factored into the market that the Fed is going to cut interest rates 0.25% or 25 basis points. Now, what will that mean for you? It means that savings rates that we see on money markets and online savings accounts are going to go down 1-for-1. Short-term borrowing rates like SOFR and other rates pegged to the short end part of the yield curve are also going to go down. Does that mean that interest rates are going to go down on the intermediate to long end of the curve? Not necessarily. And that really has more to do with what's going to go on with the economy and what's going to go on with inflation, which I'll get to in a second. But let's talk about the Federal Reserve outlook. Right now, we have unemployment at around 4.3%. The Fed has outlooked unemployment to be at 4.5% by the end of 25 and also by the end of 26, coincidentally. The market is expecting 3 rate cuts over the balance of the year, this week in September, October, and November at the upcoming meetings, around an 85% probability. As you know, in our prior market updates, we've been calling for over a year now that the Fed is going to cut interest rates 1 or 2 times. I still think that's reasonable for this year. Now, if we think about next year, market participants are expecting 6 interest rate cuts of 0.25% at each meeting next year, bringing the overall Fed's fund rate down to 2.75 to 3% based on where we are right now, coming from 4.25 to 4.5. Now, I think when you think about where the economy is going, we've definitely seen a slower growing economy in the second half, and one that causes the Fed to kind of take a step back and say, you know what? I think I can let the economy run a little hot on inflation to make sure that we still have growth and we have stability in the jobs market. And that's where our view is right now of Fed thinking. So when you look at the last year of jobs growth, that was previously forecasted from March of 24 to March of 25, recent revisions came out and actually lowered that jobs number of how many jobs are created by 911,000, which is quite significant. So when the Fed was going into the July meeting, they thought that the economy was actually moving at a better pace than it really was. And so what we've really been seeing through the U.S. economy, our assessment is that there's been rolling recessions. And we've talked about this in the past, but it seems like there's rolling recessions that are happening in different sectors of the market, at different regions or geographies of the economy. And that's really, again, due to the distortion of where the economy is right now in a post-pandemic world. And also a little bit of the distortion as well due to the uncertainty of tariffs and trade impacting business leaders' decisions on how they're making investments in people, technology, capital investment, processes, etc. So why are we having a languished jobs growth in the economy? We believe it really has to do with the uncertainty that's still out there with tariffs and trade. And we're going to hear from the Supreme Court over the next month. They have to make a decision by October 14th about the legitimacy of these tariffs, whether or not they're being used appropriately by the administration. We still think that there's going to be a level of tariffs in the U.S. economy somewhere between 15 to 18%. There's probably going to be some sectors where these tariffs hold up, and maybe there could be some adjustment in others. But on the balance of it, and putting it all together, even though the last 3 months average jobs growth has been around 29,000 on a rolling 3-month average, a lot of that, I think, has to do with this uncertainty with tariff and trade. So is there a possibility that jobs numbers can improve moving forward? I think so. But is it going to get back to those robust numbers that we've seen over the last 1 or 2 years? Probably not. So if we end up with jobs growth somewhere around 50,000 to 75,000 per month moving forward, I think that's a good news item. The Fed's going to key in on that. Inflation, getting back to that, I think is benign. We've seen that in the most recent jobs report, inflation report, month over month. Yes, it's higher year over year. So the stickiness of inflation is working through the services part of the economy right now. Capital goods prices have gone up, but I think demand is sensitive to price. So as time goes on, demand will be sensitive, will slow. That will cause these numbers to come down. But are we going to be operating at this 2% inflation number that the Fed keeps talking about over the next 15 months? Probably not. The only way we get to some of these numbers that the Fed is forecasting on inflation, like 2%, is if the economy goes into a recession. And I'm just going to let you all know, we're going to go out there on a limb once again and say no recession over the next 15 months for the U.S. economy. There's too much of a flow-through impact that we're seeing with the one big beautiful bill. Tax incentives are causing companies to invest in infrastructure and capital equipment, which is a good thing. We're also seeing individuals getting a little bit of a benefit moving forward from a tax point of view. But I think the biggest thing to think about is going to be this trade-off between the price of goods and services relative to trade, and how does the rest of the U.S. economy move and the markets move forward. Because at the end of the day, the economy is still supported by the upper income bracket spending. And we still think that spending is going to occur, assuming a positive backdrop from an economic point of view. Now, if you take it back to the stock market for a second, 2026 earnings right now are expecting 13% year over year growth. However, when I look at these outlooks based on where we are right now, we're seeing earnings growth coming from areas outside of mega cap tech. So as much as the market is priced to perfection with a 24 times multiple on forward price to earnings, which is about 7 levels higher than the historical average, that's really because 43% of the index is influenced by technology companies right now. We're looking at the other companies making contributions over the next 15 months. So when you think about your equity profile, we're not looking to add to equities right now because we like the earnings story. We're not looking to take away. We're just trying to make sure that we're broadly diversified between large, medium, and small, international and domestic. Our view hasn't changed there. We think small caps will probably catch a bid as these rate cuts play out, assuming a good economic backdrop. A weaker dollar is going to be good for international equities. And I think those dividend paying stocks in a lowering interest rate environment will also catch a bid. And I think the AI story will also continue. On the bond side, we're continuing to be short in duration. Let's not try to time the bond market, recognizing that there could be sensitivity to rates and inflation on the intermediate to longer end. I think, the 10-year treasury is probably going to hover around 4%. The only way it goes down to 3%, again, is if we have a recession, which we're not calling for over the next 15 months. So can bonds still make money while stocks make money over the next 15 months? We think so. And I know this sounds like a rosy outlook in light of some of the trade uncertainties and some of the global conflicts. But, all in all, when we kind of take a look back at history, and again, history doesn't repeat itself, but it often rhymes. There's only been 3 non-economic events that have caused the markets to go down 20% or more. A global conflict is definitely part of that. Has the market priced in, global conflicts heating up around the world right now? No. So that is probably one of the bigger black swans or things that we have to pay attention to, which could cause some disruption in the markets. But assuming that doesn't happen over the next 15 months, or those things are at least abated to a full large conflict, I think investors will come back to earnings. So if earnings are there in October and outlooks for next year continue to hold, we see the Fed cooperating on rates and inflation stays in a relative range, and we continue to see progress on trade, which I think we will over the balance of the year. We're still painting a strong outlook for the financial markets, both in stocks and both in bonds. So let's see what the Fed says. The most important thing to pay attention to when they announce the rate decrease on Wednesday afternoon is what are their outlook. So let's pay attention to the outlook. Then we get into the second half of September, a little bit of a soft period as we get into earnings in October. And then let's see how we finish the balance of the year. So we'll continue to keep you updated, but right now our barometer is take advantage of dips in the market, stay where we are on the fixed income side, and continue to be diversified across the equity complex. So thanks so much for your time. I hope things continue to move in the right direction for you and your families. Hope everyone's well. And again, always a privilege to be able to manage your wealth, help you throughout the year with things on a personal level, things on a business level for some of our small and medium business clients. And again, thanks so much, and all for now. And we'll give you another update as we learn more.